Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm back with another weekly economic review, this time for the week ending September 24th, 2021. So let's start with a look at the markets at the close on Thursday. We're almost done with Q3, heading into Q4. This week, negative returns for bonds, higher interest rates on the week, concentrated mostly on Thursday, in reaction to the Fed decision. So more on that in a few minutes, but year to date still in negative territory for bonds. Equities, well, the TSX was negative with emerging markets. Other markets were positive on the week, but when you bring everything back in Canadian dollar, since we had a strong appreciation of the CAD, well, it's the other way around. The TSX outperformed year to date, still neck and neck with the TSX, Nasdaq and EFI neck and neck too, and then emerging markets going nowhere year to date. Other markets, as I said, oil higher, CAD higher, euro higher, and the price of gold still under pressure and volatile, minus 0.7% on the week. So COVID, I'll be very quick. Charts are getting worse for hospitalizations in the country. Alberta is seeing its hospital system being under a lot of pressure. Elsewhere in the country, we are also seeing this wave of hospitalization. So vaccination is doing its job and not leading to negative cases, so to dire cases of COVID, but still the risk of COVID remains alive and well. So sadly, we still need to talk about it as much as this. So going to the global economy now, the OECD came out with their updated forecasts for the global economy. OECD, IMF, World Bank, when they produce forecasts, we bring them to you. So when you see red squares, it's because red rectangles rather, because there was a downgrade. So the world economy was downgraded a little bit from 5.8 to 5.7% this year. Next year upgraded to 4.5. So still very, very strong figure for global growth. So no worries there. Closer to us, Canada downgraded to 5.4, the US downgraded to 6, still very high numbers. And next year, Canada should have an advantage over the US, 4.1 versus 3.9. And we do believe that the strength of Canada's labor market makes Canada's recovery much more, having more room to run than in the US. So stronger footing. Euro area revised positively from 4.3 to 5.3. That's a very strong upgrade. And on top of that, 2022 was upgraded. So when you look at the tripod, so you have China, which is having some issues, but still growing very strongly. You have the euro area gaining some momentum, and you have the US with still a lot of momentum. Well, you have the global economy that's under very strong footing for the time being. So that's a very positive development. Closer to us, retail sales. So here, this is from Scotia, but this is the growth in retail sales by category since February of 2020. So just to see what compared to pre-pandemic levels. So retail sales are above pre-pandemic levels right now. GDP isn't there yet, but retail sales are. So Canadian households have a lot of money they're spending, but there's also because we change our habits now. We spend more on services than retail sales as a society. But during the pandemic, it flipped because you can't really go to the restaurant or to the hotel as much as before. So more spending on goods. So month over month, the figure was negative for retail sales, and expect some more pressure, but you're at very high level here. So retail sales will be going down slowly, but services spending will be picking up. So it's completely normal, very healthy picture here. Federal Reserve in the States, well, Mr. Powell did say that the taper almost should, but could be announced next meeting in November. They could start tapering by the end of the year until mid 2022, so the summer. So remember that they are printing $120 billion a month at the Fed to buy bonds on the market to keep interest rates low. So now they will stop doing that slowly and progressively all the way through the summer. So this is almost done. Now rate hikes, when will they be coming? Well, here you have projections for the year 2021, 2022, 2023, and the projections from last March, from last June, and the recent projections, the purple sticks here. So as you can see, before it was nothing in 2021, 2022. Now we're starting to see maybe a rate hike next year by the end of the year. So that's much close, that's much earlier than we expected. And in 2023, now maybe 4 hikes, 3 to 4 hikes in 2023. So rate hikes are coming maybe a bit faster than what Mr. Powell seemed to hint at Jackson Hole. So that explained why interest rates picked up on a Thursday. So financial markets in last week, I discussed this, the S&P 500 bouncing on its 50-day moving average, saying that, well, the macro financial tools that we look at when we do our investments on our end, well, many don't really make sense based on an historical basis. So now we look at technicals and we recognize that, well, it seems that every time there's some short-term weakness in the market, some buyers come to buy the dip and buy the dip and buy the dip. So this week we did see a piercing through the 50-day moving average, but we bounced right back. So it seems that the music continues. And when you look underneath the surface, this might be the most important page here. So the indices, the decline from the recent high on the table on the left, on the top part of the table, very shallow, 2.3% for the S&P 500, 5.2% for small caps in the US, so the Russell 2000. But you know that the bigger the company, the more weight it has in the index. And the biggest companies in the indices are keeping the indices up right now. So if you look at the average stock, the decline from the recent high, you are in correction territory of minus 11% for the S&P 500, all the way to minus 27% for the Nasdaq. So strong pullback of the average stock. And that's what is shown in the chart on the right, that the percentage of members trading above the 50-day moving average now is at 30%, which is in line with previous buyable lows. So maybe that tells you that, well, being too negative on the S&P 500 on the stock market in the US is not warranted. So that's why we didn't turn defensive. We stayed neutral. So it was a good idea. We still think to take some profits through the late spring to the early summer. Now staying defensive, we might have a good end to the year. But if you look at the average stock here, well, it's a good environment for stock pickers to add value when the average stock underneath the surface has already underwent a correction. So moral of the story here, it's you need to protect capital, but being too defensive, too quickly, too negative can also can also bite you. So you need to look at what's going on underneath the surface. So what to watch next week? In Canada, we'll have the manufacturing PMI and GDP growth for July. Should be negative month over month for July, minus 0.4%. So expect a negative print. And in the US, we'll have consumer confidence, GDP growth, and the ISM manufacturing index. All three should show a very still strong US economy. So that's it for this week. If you want to reach us, ia.ca/economy. If you haven't done so, you can subscribe to our newsletter. And if you want a PDF copy of this presentation, just write at economics@ia.ca. So thanks everyone, and I'll see you again next Friday.